Good afternoon, everyone, and welcome to this InvestSense webinar this afternoon. Thanks very much for joining us. We appreciate you taking the time out of your day. Before I get into the topic of today's discussion, I just want to quickly run through some housekeeping rules. Firstly, the format of today's presentation is a webinar is a 45 minutes presentation by our guest speaker, followed by a Q&A, which I will facilitate. On the Q&A, please, there is a Q&A button at the bottom of your screen. Please type in any questions you may have. We'll try to get through all of them in the allotted time. If we don't, we will respond to you an email response with our views or around your question. All right, today's discussion certainly is an interesting time. Something that we've spoken about a lot, which you would have heard from, whether it's in previous presentations, webinars, our one-on-one engagement with you, all the communications we send out is markets move in cycles. I mean, that is a core investment principle that I think recently might have been muddied in terms of some of the markets, but at the end of the day, all markets move in cycles. Now, there's a lot you can do to try and incorporate that into portfolios, and you need to incorporate that into portfolios. What we do from an InvestSense perspective is we spend a lot of time understanding the portfolios that we build for you as clients. We spend a lot of time understanding what goes into those portfolios, the funds that go into those portfolios, the different asset classes that go into the portfolios. And then from that, we spend time understanding how those different parts of those portfolios react in different types of markets, or different parts of the cycle in the market, whether it be how equities react, bonds react, or whether it be how different asset managers react to different parts of the market. As I said, we spend an enormous amount of time on that. The second part of our process, or what we find is exceptionally important then, is to take that portfolio that is being researched and built, and then marry it up to a client, yourselves. What are the needs that you are looking for in an investment need, whether it be saving for a holiday, retirement, kids' education? We then make sure that that portfolio that we have built is married to the need or your specific financial plan. And then the third point, which is often quite hard in times like this, is we need to let that portfolio do what it's supposed to do. Now, as I said, the reason we spend so much time speaking to clients like yourselves about markets moving in cycles is that it can be very difficult or uncomfortable at times when markets are, for example, like they are today. Lots of noise, lots of headlines, lots of tweets or X's, what you call them now. And that can affect confidence, or it can create a little bit of uncertainty in clients' minds. So we spend, again, a lot of time trying to understand markets, understand the portfolios, and then letting those portfolios do the work. Because of that, although we are very aware of what's going on in the short term and the noise that is happening, we have to be aware of it. We don't want to make reactive decisions in portfolios. We're investing for that period that portfolio is designed to invest for, whether it be 10 years, long-term, or a shorter-term need, but we want to limit the short-term reactive decisions in portfolios. Now, there are exceptions to that, and I don't mean exceptions to reacting reactively or making changes reactively, but there are exceptions when markets are so noisy, headlines are so often and so big and so trying to headline grabbing. There's lots of discussion wherever you turn around what is going on at the moment, whether it be politics, whether it be local politics, global politics, whether it be tariffs, Trump, wars, Europe, EU. I mean, the list is endless. So there are times when we do think it's important to pause, to spend a bit of time and try and make sense of what is going on. And I use the word try quite specifically because at the end of the day, as I said, there is a lot going on, so we need to just try and make sense of it. To help us do this today, we've invited Ian Jones, who is the CEO of Fundhouse, to share their views and their, I suppose, try and cut through the noise for us and try and make sense of it all. For those of you who don't know, Fundhouse is an investment consultant. It's an investment consultant business that we use extensively. We have employed them we work closely with them. They do all of the research, the fundamental work that goes into portfolio construction globally, locally, understanding what goes into portfolios, how portfolios react, and how the various components in our portfolios react. So I don't want to take any more time because it is going to be a very interesting discussion. There's lots to get through. So I want to hand over to Ian. As I said, Ian is the CEO of Fundhouse. He joins us from Cape Town, and I will see you later for some Q&A. Please don't forget to type in your questions. Thanks, Ian.
Thanks, Matt. Appreciate it. And welcome to everyone who's joining us today. I've entitled the chat today, Trump, Tariffs and Tantrums. It feels like every single time I open a news site or look at Twitter or X or any form of media, it feels like one of those three things is in the headlines, either Trump being Trump, tariffs flying around, or someone's throwing a tantrum. So felt like it was an apt intro. And then to try and make sense of investing in what's an increasingly noisy world. So we'll go through a few parts around that and then happily take questions at the end, as Matt said. So I think it's quite important when talking about what is going on in the world at the moment to understand where we've come from. And if we just kick off by just having a look at some market metrics, just to position ourselves as we launch into it. So what this table shows, and I've stolen it from Coronation, I think it's a pretty good summary of markets. This is as at the end of December last year. And it just shows the major indices around the world and how they performed over 1, 2, and in our view, very importantly, 5 and 10 years. Starting on the left, you've got the MSCI World, which is basically a developed market index. Takes, the US probably is about 2/3 of that at the moment. So a very, very significant portion, but then takes portions from other stock markets around the world. The second is the S&P 500 as it is. The third is the S&P 500 equal weight. And basically what that does is it gives a measure of how concentrated the market is by assigning every single stock in the 500 the same weight. So the mega caps, what often referred to as the Magnificent Seven, they are effectively paired back by being equal weighted with the other stocks. Then we look at the 4 regions, the emerging market, UK, Europe and China, just by way of comparison. And there are a few things to chat through from the numbers. The first one is just how well the S&P 500 has done, not just over 1 and 2 years, but also over the 10-year period. And if we look at how that's been explained and how people talk about it, these words, this tagline, American exceptionalism, comes to the fore. In December, a lot of the conversation was about, how amazing America is, how brilliant they are at running businesses, how they were the leaders in terms of, innovation from a tech perspective. They were leading the AI race. It was very much a case of the US can do no wrong. And a lot of the large cap American stocks were, if you want to call it, priced for perfection. If you then compare that to the 4 regions, you compare that concentrated bet showing that it's quite far ahead of the equally weighted. You compare that concentrated bet against emerging markets, UK, Europe, and China, and you can see just the sheer amount of outperformance that have happened over the last 10 years. If we use China, the far column as the comparison, because it is the most extreme, the US has outperformed China by 11% per year for 10 years. If you compound that, it's close to 150% of outperformance by investing in the US stock market compared to China, which is, it's an incredibly material difference. And the same really applies to all the regional markets that have been struggling. A couple of, I think, quite useful points to ponder here. The first is if I had to put the 10 years before in here, then China would have been the top performing index and the S&P 500 would have been the second worst performing index. So things, as Matt pointed out, do work in cycles, but we have had a long cycle of US dominance, S&P 500 dominance, and that dominance has been driven by the Magnificent Seven, absolutely driven by the Magnificent Seven. What this graph shows is the performance in the sort of green color of the Magnificent Seven, which is made up of Apple, Amazon, Google, or is listed as Alphabet, Nvidia, Meta, or as we would know it, Facebook, Microsoft, and Tesla. And those Magnificent Seven stocks If you look in 2021, 2022, 23, 24, you can see that material amount of the market return, the US's dominance, has come from those 7 stocks. The most extreme year is in 2023, where close to 2/3 of the entire market return of the S&P 500 came from the 7 stocks. So really, really has driven returns. The other way of that being encapsulated is by how much the weight of the top 10 stocks in the index has risen, and we're at the highest point ever of concentration within the S&P 500, with close to 40% of the S&P 500 being represented by just the top 10 listed stocks on the market. 10 out of 500 stocks give you close to 40% of the market cap, which is a massive concentration. And then if we look at valuations, or a blunt measure of how expensive the market is, you can see that at the moment, as at the end of December, the top 10 stocks were trading at 29.2 times. The S&P as a whole was 21.9 times. And if you compare that to long-term averages, pretty expensive across the board, but exceptionally expensive within those top 10 or the Magnificent 7 stocks. So that was the end of December last year, and it positions where we've come from, a really, really strong drive of sort of close to 15 years of markets being driven up by the Magnificent 7. And I suppose the question is, well, what's changed? We sort of 3-ish months into the new year, and it feels like quite a lot has changed. I mean, Trump has been front and center of pretty much everything this year. And in some cases, that is because he really has taken decisions or implemented things that have had a material impact. And in other cases, he's become almost a caricature, and the media love it and the media thrive off it. But it very much is front and center for us. What we find quite fascinating is that leading into the election in November last year, the view was that Trump would be good for markets, that Trump was market friendly. He was, as a general rule, always had policies that were to reduce taxes and to increase sort of infrastructure spend, and very positive for business. When I talk to people now, or I listen to asset managers around the world now, it's a case of, well, we aren't so sure about that. A lot of the actions being taken by Trump do actually create a bit of a problem for businesses, particularly in the US, as a result of tariffs, as a result of the impact on inflation, as a result of, I suppose, the global businesses that are listed in the US featuring a bit of pushback from foreign countries as a result of tariffs. So there's quite a bit going on, and Trump, as I say, is front and center. I would point out that this is actually his official photo as at the inauguration of him as president, and it really is quite an interesting photo to choose as your official pick. So what now? Trump's in power. We're sitting here, he's doing quite a lot of things. And the answer for me on the what now question is that no one actually knows. We have quite a lot of commentators, people out there sort of giving their views on what's going to happen. The honest answer is that no one actually knows what is going to happen. No one would have predicted that Trump would come out and side with Russia in the Russia-Ukraine war. There was no sign of that. There was no indication that Trump would be as aggressive on tariffs as he has been and take on the European Union. There was no indication that he was going to effectively pull a lot of defense support for the European nations, and definitely the nuclear sort of, I suppose, cover. So there's a lot that's happened that no one could have seen coming, and the only thing I would say is that Trump doesn't instill great confidence that he's going to let you know in advance of doing something just as crazy going forward. So no one really knows. And I think these charts really do show it. It's an institute called Macrobond in the US that does something called the Trade Policy Uncertainty Index and the Economic Policy Uncertainty Index. And it basically measures the extent to which people in the media and online are worried about policy uncertainty from an economic point of view, and also from a trade perspective. And you can see there's been a huge spike in the last 6 months around the certainty on trade. And when there's no certainty on trade, it's a very, very difficult thing to manage an investment portfolio if you are basing your decisions purely on macro. So yeah, lots of uncertainty. People don't really know what is going to go on. And that's why we always settle back on valuations being so important. What do we know? We know that Trump loves tariffs. It's quite amusing. He was quoted in a speech saying, "To me, the most beautiful word in the dictionary is tariff." And apparently he got such a high amount of pushback and complaints from his voter base because him saying that he liked tariff more than anything else. So in his next speech, he came out and said, "Tariff is actually my fourth favorite word in the English language behind God, love, and religion." So yeah, talk about your voter base having an influence. But anyway, he loves tariffs. He thinks tariffs are amazing. And what I thought would be useful is just quickly run through a bit of a Q&A, frequently asked questions around tariffs, because what I've found when speaking to people is there's a general lack of understanding of what tariffs are and how they work. So just quickly, I mean, what are tariffs? How they're collected? Tariffs are effectively an additional tax that's imposed on imports into a country. So if steel is sent on a ship into the US, it arrives at a port, and at that port, the Federal Reserve will basically impose a tariff, and that tariff will be collected at the port of entry and paid by the company that imported that good into the country. So it's collected at the ports of entry by the government. What has happened in history? I find this quite interesting. I mean, I've been reading a little bit about tariffs over the last sort of 3 or 4 months, and tariffs used to make up 90% of all the revenue for the US government. So pre-World War One, from a period of about 1850 through to World War One, tariffs made up more than 90% of government revenue. Personal tax, corporate tax was just really didn't exist. It wasn't a big deal at all. Post World War II, the coffers were incredibly dry and empty, and they had to fill those coffers, and tariffs weren't, there wasn't enough global trade. It was a massive slowdown. So in order to generate income, they imposed very high levels of personal tax. The top tax bracket in the US got to 80%. And that was how they generated revenue for the government in order for them to start rebuilding the economy and refill, all the reserves that had been spent. So history tells us that tariffs have been very front and center back in history, and Trump's preference is to have a significantly higher proportion of the US government revenue come from tariffs, and then to compensate with lower taxes. Whether he's able to do that or not, we'll wait and see. Who pays the tariffs? Trump goes around telling everyone that the foreigners pay. Well, actually, the person who imports pays. They can be compensating, but it's the person who imports that actually pays for it. The 4 main reasons why countries introduce tariffs. The first is to generate revenue, fairly obvious thing. Add some more to the tax revenue, and that can boost it. The second is to protect domestic industries, and Trump talks a lot about this. He would like to get manufacturing up and going in the US again. He wants to reindustrialize the US. And he talks a lot about that. Whether he's saying that for his voter base or whether he really believes that it's going to be possible to get to the point where the US can compete on a manufacturing basis with the rest of the world remains to be seen. In Trump's last presidency, when he first introduced a tariff on steel, the message he sent out was that he was going to introduce these tariffs because it would get all the steel mills running in the US. He introduced the tariffs and no steel mills went up and running in the US. Basically, labor and other costs are too high in the US for them to compete even with the tariffs back then. Whether that changes, I guess we wait to see. The third reason is to punish foreign countries that have a form of predatory trade practice. So in history, there've been lots of examples of countries where they've had excess supply of something, dumping those goods in other countries and disturbing price levels. So the way foreign countries deal with that is to apply a tariff to make sure that there's no, distorting of prices. And then the final one is to place pressure on other countries. And in my view, this is the main reason at the moment that Trump is making use of tariffs. And I'll take you through a few examples there. But those are the four main reasons that countries use tariffs. What are the consequences? Well, someone's got to pay for it. So you don't add, let's use the number 25% to the price of steel and sit there and say, well, there's no consequence. Someone has to pay for it. So one of three parties pays for that. The first is that the foreign country that is making the steel, bringing it in, says, well, if I want to keep my market share, I'm going to have to drop my price, and they drop their margin and drop their prices so that the steel is still competitive when it gets into the US. The second one is the company that's actually importing the steel to manufacture or to build something absorbs the cost. So the foreign producer gets the same cost, and the extra tax is paid by the people importing. That obviously impacts their bottom line, impacts their profitability. And then the third is that the additional cost is passed on to customers. So that's through higher prices, and that's by its very nature inflationary. People have asked me quite a lot, well, what do I think is going to happen in the US? And the answer is, I think it'll differ based on the underlying good. Is there another option? If there's another option that can come in and undercut, or if there's a domestic producer who can produce, a lot of the foreign companies will drop their prices. If you're a big importer and you want to stay competitive, you might take a portion of it, and then some will be passed on to the customer. So it depends on the good, but it's probably likely to be shared between the three. The other consequence is that retaliation is very much commonplace. So we've seen that over the last few months. Trump's introduced tariffs, and whether it's China, whether it's the EU, various countries have retaliated by imposing tariffs or threatening to impose tariffs of their own. And that, as a general rule, is not good for global trade and not good for global GDP growth. But it is the way people try and protect themselves. So that's a quick Q&A on tariffs. Quite importantly, even though Trump makes it quite hard to like him, and a lot of people don't like him as a person, the US are really getting sort of bashed as they're the ones imposing the tariffs. The reality is that for a long period of time, the US has actually really liked free trade and been very open to it and being a big part of the deglobalization. So have had very low tariffs. This shows the tariffs and other trade barriers put in place by the various countries. And you can see that the US, this is the G20, I should mention. And within the G20, the US actually has the third lowest in terms of trade barriers at the end of 2023. They have increased since then, but they're still nowhere near the country with the highest level of trade barriers. Others do this, lots of people do this to protect their economy. It is not sort of an unknown thing, and it's worthwhile just because sort of the US is getting bashed for it. It might have a lot to do with the individual, the person that's delivering the message, and how he's doing it rather than the actual introduction of tariffs. Just a quick snapshot of certain countries that I found really interesting. The fact that India, South Korea, and China, this is as at the end of 2023, the latest available data, and they imposed the largest tariffs. And India have been doing it for a long period of time, where they've imposed high tariffs to try and build their manufacturing capability, and they've done a really good job of it. And then South Korea and China make a lot of the goods and services that are sold in the Western world, and they use tariffs to protect those industries and help them. So just got to keep a balanced view of who imposes tariffs and why. The other thing I found quite interesting, given that China and Russia are seen as best friends in some circles, and that Russia has actually imposed a tariff on Chinese motor vehicles because basically China are dumping a lot of their excess supply of motor vehicles in Russia and distorting the market there. What is the rationale behind the US and tariffs? They have some reason to want to introduce tariffs, apart from Trump saying he loves them. The first is, I think, quite well represented by these two pictures. They show the trade deficit and trade surplus, i.e., imports versus exports of countries in the world. And on the left, the biggest trade deficit, you can see that the US outstrips everyone by a factor of at least 4. They had a trade deficit at the end of 2023 of $1.1 trillion, and it hasn't reduced much from there. And the next one in line is India at only 245 billion. So a very, very significant issue for the US is the size of their trade deficit. If you then go across to the trade surplus, you can see China there sitting at sort of double anyone else's at close to 600 billion. And this is something that Trump and his fellow US government officials just really are not comfortable with at all. It's been going on for a long time, and they want to narrow it. I mean, it is a point to make is that a trade deficit in and of itself isn't necessarily a terrible thing. It depends on your economy, and the US economy is sort of driven more than 70% by the consumer. So it's not in and of itself the sign of a failing economy, but the US is just worried about how big the trade deficit is, and they want to reduce the amount of imports and increase the amount of exports by supporting production. The second is the number of manufacturing employees. So this has been falling for a long time. The US has effectively been hollowed out from in terms of manufacturing in a large way. And you can see this is the number of employees that are employed in manufacturing in the US, and the number has fallen quite materially from the 80s to now. And this is an absolute number. So when you take it as a percentage of a growing population, it is a material drop in terms of the jobs and the percentage of jobs that come from manufacturing. And Trump talks a lot about this, the desire to create manufacturing jobs and get middle America back working in manufacturing jobs. Whether this is achievable or whether the Americans want to take low-paying manufacturing jobs and try and compete with China and other Asian countries remains to be seen, but it certainly is front and center of the politics for Trump. The next one is immigrants. You would have heard a lot about this, and to be honest, there's a lot of fake news about immigration and lots of sort of people trying to influence the story. The bottom line is that the number of immigrants, and particularly the number of illegal immigrants, has increased materially in the last 30 years, and over the last 10 years, the number of illegal immigrants, has increased quite materially. And this worries Trump, it worries the economy, and it's pretty much front and center of what Trump sort of ran his political campaign on. He is wanting to use tariffs as a way of encouraging, to use that word, encouraging other countries to do something about their borders. And I'll give an example of that in a second. Then the other big one is drugs. The US have got a big drug problem, and particularly fentanyl. This graph shows from 1999 the number of drug deaths, and you can see the spike over the last about 8 years, and particularly the grey line, which is fentanyl. The yellow line is methamphetamines, and one of the things that is spoken about in the paper that's linked to this graph is that methamphetamines, one of the reasons that both that cocaine have had rising death rates is that they lace those drugs with fentanyl to make them more potent, and the number of deaths is increasing materially. This is really stark when you start looking at a study done in the back end of 2022 about the main causes of death in each of the age groups in America. And then if you just look at the bottom of it, the ages 18 to 44, it compares 2001 to 2002 to 2021-22. And you can see that there's been a dramatic shift across the states from basically motor vehicle deaths being the main cause of death in this age group to either suicide or fentanyl, but fentanyl leading the charge in terms of the cause of death amongst 18 to 44-year-olds in America. And this is a very material worry of people in the US, and as a result, a big worry of the Trump administration. And the way that fentanyl gets into the US, most fentanyl is made in China, and the way it gets into the US is predominantly through Mexico and increasingly through Canada. Last one, which is a little bit, it's linked to both the tariff rationale, but also to Elon Musk's Department of Government Efficiency that's been launched, is that the US is basically spending more money than they're getting in. So their government expenditure outstrips their tax revenue, and that is leading to bigger deficits and large debt needing to be issued. And one of the drivers for Trump is to increase the revenue by way of tariffs, but also to attack the expense side. And we're seeing quite a lot of news about things that are going on there, rightly or wrongly. Looking at a couple of examples, a lot of people were very surprised when on the first day of Donald Trump being president again, he issued an executive order to impose tariffs on Mexico and Canada of 25%. But this tweet is actually from the day he won the election, or day after he won the election. He basically said that drugs and illegal immigrants were coming into the US from Mexico and Canada as a result of open borders. And if they don't do anything about it, he was going to impose a 25% tariff. What then happened was that he got to a point where he became president sort of nearly 3 months later, and both Mexico and Canada had done pretty much nothing about the borders. So he said, okay, I'm introducing 25% tariffs. Canada then sent 1,000 additional troops or army to the border, and then on top of that sent Black Hawk helicopters to try and help close the border, and that's why Canada were given a stay of execution for another month. So yeah, I'll leave you to make a call on whether it's right or wrong, but Trump did definitely give people warning of this coming, and then followed it through. The other one that I found quite interesting was how he used the tariffs. There was 2 repatriation flights that went from the US to Colombia, and they were refused. The president of Colombia refused to let them land, and so the illegal immigrants were taken back to the US. And Trump threatened 25% immediate tariffs on every Colombian import, with another 25% added within, I think it was 50 days. And the outcome of that was that the Colombia government sent 2 planes to America to go and fetch the criminals and bring them home. So he's using tariffs not only for the protection of industries, not only for the revenue, it's also to force the likes of Colombia to do his bidding. The one that's closer to home for us, and nothing's come of this other than this threat at the moment, but BRICS started speaking about launching a currency that would replace the US dollar as their form of trade. And Trump basically said if that happens, he'd impose 100% tariffs on the BRICS countries or anyone that supports it. And we can laugh and we can say Trump's crazy and it would backfire if he did it. But you've still got to also take cognizance of the fact that us sitting as the very small S in BRICS, 100% tariffs from the US would be devastating to certain parts of our industries. So we've got to be careful about just laughing about it. The other one that I did laugh a little bit about is that the EU, in response to Trump's tariffs, said that they were going to put a 50% tariff on whiskey being imported from the US. So Trump responded by saying, well, he'd place a 200% tariff on all wine, champagnes, and alcoholic products coming out of France and other EU countries. And if that were to happen, it would devastate the French wine industry. So there's these games being played all over the place of threats and counter threats and negotiation, but it is a big deal, and it will change global trade if it is implemented. If it isn't implemented, if it's only part of a negotiation story, the impacts will be obviously far more muted. The other thing that's causing significant macroeconomic shifts and foreign policy changes, but also market impacts, is defense expenditure. So the US this goes back to 1960, where from 1960 until now, the US has averaged 3% of GDP spend on defense. whereas the EU states have steadily declined from 1960 to the point where they dropped, below 1% on average in 2015, 2016. And it's slowly been increasing. But one of the things that Trump is sort of, I suppose, up in arms about is that the agreement was that the target would be at least 2% of GDP being spent, and the EU were spending on other things, and the US was running up this deficit by spending and then providing protection to the Eurozone. And Trump sort of threatened that that's going to be taken away, and they're no longer going to act as the sort of the last defense for Europe. And they're going to, very importantly, take away the nuclear capability from Europe. And this caused a lot of consternation in Europe. I think the Second World War is still relatively, remembered across Europe by a number of people. So it scares them for good reason. And what we have seen is a lot of EU nations step up and say that they are going to increase their spending on defense and on rearming. And the place that's signaled that the highest is Germany, and where Germany, the incoming German government have indicated they will take on more debt to fund a significant uptick in defense spending. And what that's led to is a big impact on the German market. What this shows is the major indices that have and how they've gone from the 15th of December to date. And you can see the top two lines there that have sort of done well, or the markets have done well over that period. The purple line right at the top is the Hang Seng, the Chinese index, and then the black slightly below it is DAX, which is the German index. And the German index is driven by but basically by the defense industry and other industries that are associated with the manufacturing of arms. While the Hang Seng, there's a number of reasons. The primary reason being the Chinese have committed to stimulus for the country, and they've been dropping interest rates and providing funding. And the second reason is that, and we'll chat about in a second, where there's been I suppose it's been global, but a global acceptance that China has a part to play in the AI race, and it isn't only the US companies that are going to lead the charge. And I'll spend a little bit of time on that. Since that middle of December, the grey line at the bottom, the one that's sort of, I suppose, had the least good outcome over that period, is the NASDAQ, the darling NASDAQ, with all the tech shares that has been the leading index. This is only a period of 3.5 months. So, you've got to read it as that and take it as that. But there has been a fairly material shift. I mean, 30-odd% difference in return between the bottom and the top there. So it's been material in a very short space of time. Suddenly you're getting quotes and tables that talk about less than magnificent, big tech sell-off. This is the Magnificent Seven, and you can see that their price earnings ratio, which is a sort of quite a simple measure of price, and you can see it's fallen materially, but it's fallen from a level of 40 times to a level of 30 times, and with 30 still being, I suppose, relatively expensive. Same table as I showed earlier. The top 10 are now trading at 27 times, with the S&P 500 at 21 times. So you've seen a bit of a pullback, but still well ahead of the average of 20.6 on the top 10. I also enjoyed this chart, which shows the PE ratio, again, the blunt measure of the S&P 500 compared to the MSCI All World, excluding US. So the rest of the developed world and how they have done. And you can see that the gap between US and the rest of the world is still exceptionally wide. So not saying that it's going to come together, but the US, because of a 15-year I suppose significant outperformance, still has a significant valuation gap relative to the rest of the developed market. But it's not all about Trump. Trump has had a big impact. The other thing that's had a really big impact on markets is DeepSeek. And I mean, for those that haven't followed DeepSeek, it's a Chinese entrepreneur. He was a hedge fund manager who put together $300 million and invested that in building a AI module, large language model, LLM model, as it's known, to compete with the likes of ChatGPT and others that were dominating the market. There were three things that were quite remarkable about the DeepSeek. The performance of DeepSeek was exceptional. It was as good as ChatGPT and others and had been done at a fraction of the cost. The second thing is that DeepSeek was built with the backing of old NVIDIA chips. So the NVIDIA provide the chips for AI, and it's a really important component of it. And everyone was of the view that NVIDIA would be the winner because every year everyone would have to replace the NVIDIA chips with a new generation in order to compete. And DeepSeek came out and did it with majority old chips. And that has given pause for thought as to whether everyone has to replace the NVIDIA chips every year. And then the third one, and it's really fundamental, is that DeepSeek made all their code open source. And so you and I can go on the internet now and download the entire code base for DeepSeek. I mean, it wouldn't mean anything to me, but if I hired a couple of smart developers that knew code, they could basically use that and adapt that to implement in a business. And what that's changed is the view as to whether these companies that have had this massive benefit of the AI premium, so their share price running up because of AI taking over the world, whether that premium should be as big as it currently has been. So it's not all about Trump. DeepSeek arrived at a point where all the tech stocks, the magnificent, were priced for perfection, and it's just thrown a bit of uncertainty into the mix. Long term, unclear, but it just, as I say, gives some pause for thought for the US dominance of AI. The other thing is that there's been a softening of earnings. And this is not spoken about. It is not in the media. And I'm not that surprised given just how noisy Trump is and how all the media houses love the soundbite. But when you've got a group of companies like the Magnificent Seven or sort of almost priced for perfection, the share price requires a certain level of growth to justify that share price. And while those companies have grown nicely, very nicely, and justified a lot of their price action to a point, there's been a softening in the growth of earnings. And that softening has started to come through in the last quarter, 2 quarters, and in our view has been one of the main reasons for the sort of fall back in Mag 7, even though it's not really what's spoken about or front and center for the news media, the mainstream. How have the investment styles fared? I mean, just very quickly, there are 3 ways that, apart from buying the index as a whole, that a lot of people invest. They use growth, quality, or value. Growth is effectively a fund manager that buys businesses that will grow faster than other businesses, and they believe that that growth will lead to the share price doing better than others. And they're happy to pay up for that growth and even buy businesses that aren't profitable because they believe the growth will lead to profit. Quality is buying, your big brand, really stable, great businesses, your Visa and MasterCard, Coca-Cola, Nestle, and they believe that those higher quality businesses will be more stable and therefore get more support and be able to justify their price. And then value is a little bit like shopping for bargains. I mean, that underplays it a bit, but you're looking to buy a share when it is cheap relative to what you think it's worth. And then as the market, normally due to earnings coming through, start seeing value in those shares, hence the name, the share price will recover to your fair value and give you that upside. And those are the 3 styles. And what we've seen over the last 10 years, 15 years, is that growth and quality have outperformed value. We chatted a bit about the reasons for that, but whether it was the quantitative easing and low interest rates, whether it was the AI support, whether it was sort of a run up of people buying the next big winners that led to expensive levels, whatever the reasons were, they've been the winners. Whereas over the last quarter, you've seen quite a significant shift in where capital has been placed, with your growth shares falling back 7% over the quarter, quality back 5%, and then value adding 3% on average. And within our portfolios that we build and the InvestSense portfolios that they have, there is an overweight to value, and that overweight has been increased over the last 3 years, 2 years, 1 year, as value has got cheaper and cheaper, and in our view, growth and quality has got more expensive. and we've started to see, I suppose, the benefit of owning the cheaper part of the market over the last 3-4 months coming through in portfolios. Still early days, and we still think there's quite a long way to go, but at least it has started to come through. In closing, just what does this all mean for South Africa? The first point is that deglobalization is not good for emerging markets. The global trade leads to, more capital being allocated. So reduced global trade is the reverse, and it leads to less resource demand, which is obviously not good for us. So generally, global growth, globalization, more being built by China, by the US, that's good for emerging markets. So this whole deglobalization is not a positive for us. We also need to be very careful as a country what we wish for. I put mistakes in inverted commas there, but the foreign policy decisions that we've made over the last 5, 6, 7 years have put us in a position where we're at risk of being pushed to one side. And whether you look at our stance around the Ukraine and Middle East wars, whether you look at our ambassador to the US and how he's handled the Trump presidency, I think you can ask questions as to whether we are making friends anywhere and helping ourselves. Because if we think that China's going to bail us out just because we're being mean to the US, I think we've got a bit of a surprise coming. So I would much rather we chose the sort of the Switzerland option and we're a friendly neutral to everyone. I think it'd be much better for our economy, but that's not what we've chosen. We've got to be careful. I think that AGOA, the trade agreement between America and parts of Africa, is definitely at risk. The way things are going at the moment, I would be incredibly surprised if that remains. And a few people have said to me, "Oh, it doesn't really matter. So what? Like we can just replace it." I think that's quite naive. I think for 3 reasons. One is that AGOA provides preferential access for us into markets in North America, but also provides preferential capital agreements back into South Africa. The second part is that at the moment, everyone is hunting for new trade partners. Because of what Trump is doing, everyone is trying to sign new agreements. The EU did a massive new agreement with a collection of South American countries, and you're starting to see all these new agreements trying to be formed. Everyone's looking for new things. And why would someone sign a good trade agreement with us at the bottom of Africa if they've got other options? So we just got to be careful to think we're just going to be able to replace it. And the third part is that no one spends like America. It is the one thing that China found out the first round of Trump's presidencies when everyone said the tariffs would hurt the US more than China. That's not been the case at all. China has replaced a portion of the trade that was damaged by the US imposing tariffs in the trade war, but they haven't replaced all of it. And replacing the consumer behavior of Americans is not as easy as people talk about. So what would we want? We would want to be friends with everyone. We'd want the US to carry on trading with us, even though the US only makes up, it's just over 5% of trade of our exports. If you take certain industries, agriculture, the wine industry, it's significantly higher than that. So we've got to be a bit careful about just laughing off such a material partner. And at the crux of it is that GDP growth really needs to be front of mind. From a macro outlook, I think it is worth pointing out there's another chart from Coronation, which I think just sort of lists the issues. In our view, there's more pros than cons at the moment. I think there is an improved political outlook with the GNU, and even though a lot of people saw the budget delay as a big negative, it's obviously not great. But the positive part of that was that it's the GNU actually working. If we didn't have a GNU, it would have just been passed with a 2% VAT increase. So I see it as actually probably positive that it's been delayed. There are a few positive moves in terms of infrastructure, mainly around the rails and around rail and the sort of the allowance of independent or private rail using the current network, which is a really positive. So there are pros, and I would say net more on the pros side than the cons at the moment. One of the pros is that we have inflation under control. Inflation printed exceptionally low again last week's, just over 3%. And I get asked a lot, well, if inflation's so under control, why are we not seeing rates being cut more aggressively? Rates were kept on hold now. Yeah, it's a tricky one. So it would be great to see rates being cut because it will be positive for GDP growth and positive for the consumer who, there's a lot of consumers that are under significant pressure, and they, a little bit of a release valve via rates would be welcomed. But there is a counter argument, and this is dominating, in my opinion, the Reserve Bank's view on this, is that our currency would be impacted quite materially by us falling out of step with the US. And if the US is keeping rates under control and we are dropping rates, it means that I suppose the desire for investors to invest into our market and take a lower rate for the risk they're taking of investing in emerging markets would lead to the potential for more money to flee South Africa and for our currency to weaken further. And that in turn leads to inflation and can have knock-on impact. So they're trying to balance this. I must admit, I was hoping for another 25 pip yesterday. I think it would have been good, or not yesterday, this week, but last week. But we'll see. The other sort of big point for us, the actual problem is GDP growth has been so weak. We look back to the 2005, 2006, 2007 era where we had growth of sort of 5.5% and, the Mbeki and Trevor Manuel era. And it would be lovely to try and get back there, but still see a few hurdles in our way to get there. It should be the core focus of everything we do, but we're still fighting that a bit for whatever reason. Having said that, SA equity is attractively priced. This just shows the cyclically adjusted price earnings ratio, which is we think a pretty good long-term measure of where SA equities are priced relative to their own history. The grey line in the middle is the long-term average, and then the black lines above and below are the two standard deviations above BO. And you can see we're below the line, and it shows for us that SA equity is offering value relative to its past. And if you believe that you can have some wins from the rail and from load shedding remaining away, SA equities do offer value. Bonds are also offering good value. You can see this is just the yield curve, and you can see we've had a reduction in yields from the dotted light blue line of a year ago. And that was off the back of the GNU and positivity around sort of an improvement in South Africa's conditions. The one thing that does concern me a little bit about SA bonds is the potential for if AGOA were to be taken away and the US were to continue to, I suppose, be concerned about SA and our politics, that we have some additional foreigners selling our bonds. I suppose what's a weird positive on that front is that most foreigners have already sold all their SA bonds. So we watch that carefully, but bonds are offering a really good yield. In conclusion, just the currency, the ZAR. This is the red line is the PPP model, or purchasing power parity, and basically what this does, and the model's been shown to work over long periods of time, where over long periods of time, the inflation differential between countries is what guides the currency. And the periods where the rand's been incredibly strong, and that's when we had the resource boom and the China growth boom. And there have been times when we've been way above, and the mighty dollar has been the mighty dollar for the last 10 years, 15 years. And the rand has been, according to the model and in our view, the rand is at the moment cheap relative to its history. So one final slide, just to bring it all back together in closing. We still are fundamental at the heart, and we still look at the valuations. We think when there's all this noise, coming back to valuations and saying, are you buying something at a relatively cheap valuation? Because then even if things don't go your way, the probability of you making money out of that asset is much higher than buying something that is very expensive. And a quick rundown, this shows the asset class relative to fair value, both at December in the dark blue and then in grey as at the end of March. And you can see that SA equity is on the cheap side, SA bonds slightly cheap, SA property slightly expensive. Developed market equity is expensive, but that's pretty much driven by how expensive US equity is. The third line down, you can see, despite the pullback in US equity, it's still about 27.5% expensive relative to its own history, while a lot of the other developed markets are cheap, or in Europe's case, because of Germany, about fair value. And then on US bonds, they're around fair value. Emerging markets bonds slightly expensive. And then in currencies, the mighty US dollar just dominates all the other currencies, even though it has weakened somewhat over the last 3-4 months, still very expensive relative to its history. I'm going to leave it there. Matt, I'm going to hand back to you and see whether there's any Q&A or any questions that anyone would like to ask.
Thanks, Ian. Thanks for stepping through that. I think what I'd like to focus on first is offshore markets, global markets. And I think we've spent years and years talking about local markets. I think everyone's very aware of what's happening here. So the global markets, I suppose what I want to focus on, how we break that up from an investment perspective. So, we talk about, you show those graphs of indices, the S&P and NASDAQ and that sort of thing, but not all equities are reacting the same way to markets. So maybe, some of our clients will be aware of the views that we've held, through your guidance from a global equity perspective has been to be underweight or hold less expensive stocks, let's call it that, mainly out of the US, the tech stocks, and to be underweight US as a whole, so own less than the market. But then to be rather investing in the more value stocks or the different styles of equities. Maybe if you can step through that, because we don't want to come across being, I suppose, too negative around equities. Equities are not all born equal, I suppose. Maybe just kind of run through that if you can.
Yeah, cool. So if we had to look at global equities at the moment as a whole, there are a lot of relatively cheap equities available around the world. And whether that's because they are in the US, where the US has very much been split into almost 3 buckets: your expensive tech, your expensive quality businesses, as I mentioned earlier, your MasterCard, Visa, some of the quality businesses, and then the rest. And all the capital has flowed into those expensive stocks. But those stocks number, maybe 40 stocks. It's probably even less than that. And if you look at the valuations of the remaining stocks, they are cheap relative to their own history. There are lots of cheap opportunities, both in the US as well as globally. And so we find it still relatively easy to put together a portfolio of US stocks, albeit underweight relative to an index. So what we use is the ACWI, or the All Country World Index, where the US is about 65%, and in portfolios we may have between 50 and 55%. So underweight, but still half the portfolio made up of cheaper pockets of the US market. And then there are also stocks across both Europe, the UK, Japan, and the emerging markets that offer good value. And so very comfortable to build a global equity portfolio where, even though there are expensive pockets, you can build one that, especially if you've got a long-term time horizon, you can hold and deliver solid returns from this point. There certainly isn't, in our mind, flee equities, run away from them if you've got time horizon. I would add that we do think that the market's quite risky at the moment because of the uncertainty around what Trump might do and the things. So where someone has a lower risk portfolio with a shorter term time horizon, we would be slightly underweight equities, but we're talking a few percent, not taking all equities out. You still need long-term growth. So hopefully that.
Yeah. I'm just cognizant of time and questions come in, so I want to answer it. You're going to enjoy this one, Ian. In your opinion, will America put pressure on the government in resulting to dropping regulations that inhibit foreign investments? Example, BEE.
I mean, they will put pressure on. The US have sort of been very outspoken about it, lots of messaging. There's now talk that there are going to be targeted sanctions against sort of some of the ANC members based on corruption charges. There's been talk about taking the Zondo Commission, and anyone who's listed in there will have sanctions. There's lots of talk. But I think that the probability of the ANC-led government implementing any change to BE or other sort of laws within our country as a result of that pressure is zero, or very, very close to zero. The way our government has reacted so far has been very sort of, I suppose, firm in that we won't be bullied, we're not going to listen to you. You can say what we want, you don't know the truth. So I would be very surprised if anything changes as a result of the US pressure. I think what might change is that we have an impact on our GDP growth as a result of losing trading partners, which take time to replace. So could be wrong, could obviously be wrong, but I would be very, very surprised if there is a change in terms of BE requirements. And look, it is tricky. So you're placing BE requirements on SA businesses, and then if you allow foreign businesses into the country without BE requirements, that is you giving foreign competitors an unfair advantage, right?
Okay, perfect. I think just from time perspective, we'll leave it there. Thanks very much, Ian. Very informative, and thanks for your opinions on that. As I mentioned, for us, we spend a lot of time with Fundhouse and trying to understand all these aspects to try and alleviate some of these concerns or uncertainties. But thanks again for joining us. Really appreciate taking time on your day, and hope you have a good rest of the day and good rest of the week. Thanks very much. Bye.